Okay, today we're going to talk about financial statement fraud. And financial statement fraud is when an organization has willful and knowingly put out financial statements that are incorrect, that have misleaded or misguided someone. Now, that individual has potentially invested in this company and lost money. Without that loss, without that misleading, without that intent, it's not financial statement fraud. But when you put all three of those together, you've got a financial statement fraud on your hand. Let's dive deeper. So, why is understanding financial statement fraud so important for an auditor? Well, there are less financial statement frauds than other types of frauds out there. Remember, embezzlement, stealing assets is probably the number one as far as events. There's a lot of theft that goes out there. But when it comes to financial statement frauds, there are fewer of those. But when they hit, they are the most expensive and they affect the most people. It also affects the liability of the auditor because both your reputation and the industry's reputation are on the line. We could lose the confidence of the public when we miss a financial statement fraud, and we are also subject to litigation or lawsuits against us. So when is it likely that a financial statement fraud will happen? Well, usually when there's some sort of high earnings and growth expectation out there, there's conflicting incentives, whether it's bonuses or whether it's individuals who are trying to achieve certain goals, and those incentives really go against ethical financial statement reporting. There could be undesirable debt levels. So those levels of debt are high, and we're doing manipulation to try to keep that debt or prevent the bank from closing down the debt or saying we haven't met covenants. Auditor independence is lost. When an auditor gets too close to the client, then they potentially allow certain things, or they become familiar with the client and potentially accept things that could wind up being financial statement fraud. Interpretations of accounting rules start to vary. When you start hearing discussions about things related to accounting rules themselves, like I remember when Andrew Fastow was given the CFO of the Year award by the CFO magazine for his off-balance sheet financing operations with Enron. And then only a year later, the house of cards fell down on Enron. So when people are starting to talk about accounting rules and they're having discrepancies with what they believe should be happening with those accounting rules, that's when we need to start worrying that financial statement fraud might be out there. These can occur both at a macro and micro level. And what do I mean by that? Well, as an economy as a whole, there could be all of those issues happening out there, but it also could be at an individual entity level. So when you get into a particular audit of a company and you notice some of these specific characteristics happening, you're arguing about accounting rules with the controller. You're seeing that the covenants for the debt aren't being met, or they're very close to being met, so close that you're wondering if it's really being met. And then you've got those bonuses, incentives for managers that are conflicting with good financial statement presentation. You know that potentially there's a micro level fraud or an individual entity fraud going on. But to know where we're going, we have to know where we've been. So let's do a brief financial statement fraud history look. So if you go into the 80s, all you've got to do is go to YouTube and query on ZZZ Best or Crazy Eddies, and you'll hear about the stories of how, in lots of ways, the auditors weren't really doing a thorough job of the financial statement reviews and audits, and it led to these public companies putting out misguided and financial statements that were very fraudulent. There's lots of stories in the 80s about this. Those are two of the best cases, the easiest ones to find information on. In the early 90s and really even the late 80s, there was the savings and loan crisis. And if you want to know what story connects that, it's probably the Keating Five. So you'll see and hear about these senators that helped the savings and loan companies, and then ultimately they collapsed. In the early 2000s, if you're as old as I am, you remember Enron and WorldCom and HealthSouth and how the market was devastated right after the 911 events within the year or two past that. So how these CFOs, CEOs manipulated the financial statements to try to increase their stock prices and their own wealth that ultimately led to a major market collapse at that time, but not as big as the one in 2008, where the mortgage crisis, and the big one there is Countrywide Financial, led to a market crisis that was devastating in 2008 that has taken us a long time to get out of. And now we're even seeing things like in 2020, Luckin Coffee had a financial fraud in which they misreported their sales growth and store sales. So those are the ones that the media writes about. So the ones you can go into YouTube and get information on. But you as an auditor will likely see something of smaller scale, but just as bad to the involved parties. So keep your eye open at the micro level, as I said, and be aware of what's going on at the macro level, because it helps you understand what is going on or what could be going on at the micro level. So what are the motivations behind financial statement fraud? Well, really high stock prices when you're talking about a publicly traded company. And the management will say, well, we're just trying to increase investor wealth. Well, they're also increasing their own, usually because they've got the stock options. They own stock. So if they make the stock prices go higher, it benefits them. And then we even get into the billionaire crisis, or the Bezos and Musk income dilemma, as I say, because what they'll do is have these, they'll hold on to the stock will appreciate, it'll go up, they'll be able to get loans on that stock, and then they can live an extreme lifestyle without having to pay taxes because it's loans that they'll just sell their stock to back it up. So it's very important to them that that stock price continue to appreciate. So don't forget, though, it's incentive for employees' personal wealth too, because a lot of employees of these companies actually have this stock. And so they, whether they know it or not, are helping the process a lot of times because they're allowing transactions to happen. They won't become whistleblowers because they think that potentially it'll affect their own personal wealth. So they have now become accomplices to the fraud just by having a 401k that they really want to see go up so they can retire, and it's gone up quite a bit. So they, as an accomplice, won't necessarily pay attention to some of the things that are going on within the company that might lead to misstated financials. Now, the company may have large loans, and as part of those loans, there's incentives to keep covenants or accounts receivable at certain levels to back up those loans, and so they will manipulate the financial statements at time to do that. So they could also be trying to acquire loans, and they want that financial information to look good for the bank so that the bank will invest in them. Now, they could have false growth on sales or revenue, or false assets, or both to try to meet these objectives. Now, there could be bonuses out there that incent the managers. You'll hit certain goals on income, you get certain bonuses. So these incentives could create fraudulent actions. And then there's also incentives that reinforce the wrong actions. So we go back to the mortgage crisis of 2008 or so. There were individuals selling loans, and they would get a percentage of that loans just by pushing loans through. So the incentives were wrong. They still should have made sure that the people that were getting the loans could actually afford those loans and pay those loans back. So what are some of the warning signs? Warning signs that the financial statements are le crap, or not very good. Well, le crap meaning there could be a lot of legal expenses or close ties with lawyers, that there's being discussions had. And as an auditor, you're supposed to be independent, but lawyers don't necessarily have to be independent. They're out there to make sure that the client is in the best position they can be. So if there's a lot of discussion, a lot of interaction with lawyers, that can be a concern. Again, these are warning signs, not full blown, oh, they're talking to lawyers a lot, that must mean fraud's going on. No, it's just something to raise your awareness of when you're doing an audit. The E, high earnings or growth expectations. E for earnings, E for expectations. The bottom line is, if there is just a lot of pressure for high earnings, a lot of pressure for growth expectations, that's a warning sign that there could be some financial statement fraud out there, or at least pressure to do that. So you just want to make sure you're doing all your proper audit steps. Now, complexity of transactions or organizational structure, a complex organizational structure. You think of Enron and all of these little entities that they were putting out there, these special purpose entities. That was part of a complex organizational structure. But sometimes you'll see complex transactions. And when you're working at a micro level, you'll see transfers to warehouses, all sorts of transfers or adjustments or things that really are warning signs that there's potentially financial statement fraud. Related party organizations, related parties in general, that usually leads to some sort of conflict of interest, or you've got to be aware that there might be some sort of conflict of interest out there. Significant ties to another organization could mean that there's pricing schemes going on or kickback schemes going on, which are part of embezzlement or misappropriation, not necessarily financial statement fraud, but it is a possible warning sign of financial statement fraud. And if you've got investors out there, especially specific investors that are putting a lot of money into the organization and trying to influence that organization, there's a good possibility that that's a warning sign of a financial statement fraud. Relationships with past auditors, the A here. The auditors, they could be pay-related issues that have been happening in the past. It could be just disagreements over how the financial statements were presented. The bottom line is it makes you concerned if there has been some sort of significant issue with the past auditors in either one of those areas. Now, the board itself or management could have some past financial statement issues or concerns, been involved in past financial statement frauds, so you want to be concerned about that. Usually the public traded companies that everybody sees on the NYSE or NASDAQ, you're not going to see that as much because those people will be ousted. But when you get into the over-the-counter companies, you could find board or management that have had pump and dump companies in the past. So watch out for that. So you've got to listen to your inner auditor voice. So listen for the incentives that are out there and ask yourself, what frauds could management commit that would reach those incentives? How could management hide those frauds from you as an auditor? What processes could be circumvented to achieve those incentives? Which accounts would these frauds affect in the financial statements? Where do the financial statements misalign with the non-financial performance or the common performance of its peers, its competitors of the industry? Then we determine the tests. Now that we've been thinking about all the frauds and possible non-compliance and circumvention, what tests do we currently use to detect these frauds? And how could these tests be circumvented? What modifications to the tests should be made to strengthen the fraud and detect any circumvention? And then we'll perform financial statement analysis to identify unexpected or unusual relationships in the financial information and make sure that our tests focus on those areas. So now make sure you have looked at estimates, reserves, allowances, and any other management judgment that's on the financial statement. Look at significant transactions, especially near the end of a reporting period. Look at the incentive plans, as well as guarantees that they've made to other companies or to banks. Maybe they've put their own personal wealth on the line for the company. That's a big incentive. If they think they're going to lose their personal wealth, that's an incentive for them to commit financial statement fraud if things are tough. Look at changes in the way revenues or expenses are being recorded compared to the past. Look at new or significant relationships with customers or vendors and even investors. Whether the physical assets that they're talking about actually exist. Whether the financial information aligns with the peers, the competitors, or the industry as a whole. Do they make sense? Do they fit? Is there something that doesn't align with the peers, competitors, or industry? Then you need to focus on that area to make sure it's valid. Do the account balances seem realistic? Do they make sense? Are there any inconsistencies, unusual growth in sales, revenues, receivables, earnings without cash flows? Are they making money yet they're short on cash all the time? Are there material changes in the gross margin? The gross margin, unless there's some major manufacturing innovation, should be consistent. So if we see significant changes in gross margin, that's an identifier that something might be going on. And that is your overview of financial statement fraud and what a fraud examiner needs to think about.